Live on Money Mondays, Ben.
Money Mondays,
Welcome to
Disrupt
Monday.
TV, Houston, Texas. Ferris, Ben, your hosts here.
All right. What are we talking about today, Ben?
What are we talking about? We're talking about due diligence from
What
A
is
to Z.
due diligence? So
Due
wait, before we
diligence.
do that, so every Monday, 3:30 Central, we do Money Mondays, right? Basically, the idea is really going through different topics within real estate, within marketing, within anything that's kind of relevant to business, entrepreneurship, and real estate, right? And really kind of giving our experience, our knowledge on what we know about it, right? And more importantly, do a live Q&A.
Yep.
So the Q&A, we're happy to talk about anything people want to talk about. Feel free to leave the questions in the comments. We will give those a read here live and go through those, and they don't have to be about the topic, but this week we're talking about due diligence. So what is due diligence, Ben? Maybe let's go to that.
Well, you can have a couple different parts of due diligence, right? You can have the financial due diligence, right, where you're kind of going through the numbers. And then you can have the property due diligence, right? You're actually walking the property and you're checking for deficiencies, right? But, really for our discussion today, everybody, it's going to be the whole full gamut of the process, right? And let's assume that you already got a deal under contract, right? This is going to be that due diligence period that we always talk about. It's usually going to be anywhere from, I've seen it as short as 10 days to as long as 30 days is usually the due diligence period. And that is the time that the seller is allowing you as a buyer to go in and pretty much kick the tires, right? Now, depending on the market that you're in, if it's competitive market, say DFW, you might have non-refundable hard money. So even if you get in and you kick the tires, you decide, hey, this deal is not for me, I cannot make any money because something fundamentally has changed, you're not going to get that money back. But in some other markets, right, you go through the due diligence process, you get up to, the last day and you just say, hey, it's just not going to work out. I'm going to go ahead and cancel the contract, and then they'll give you your earnest money back. Now,
But really, but due diligence fundamentally is what? You're validating what you're buying is what you think you're buying.
Yeah, you're kicking the tires, you're popping the hood, you're checking all the skeletons in the closet, right? You're making sure that your pro forma, your underwriting of the deal is correct, right? And you're buttoning a lot of these things up during the process, right? You're buttoning up your rehab plan and your budget, right? You're making sure that all of your numbers work from a financing perspective. You're making sure that your insurance works from that perspective, right? This is giving you time to really kind of button up the whole entire thing.
And as a buyer too, it kind of gives you time to also get the rest of your house in order, right? If you actually think you're going to move forward in the deal. So it serves multiple points. But really, due diligence, let's maybe run through our slide deck and kind of talk through that. And so for those of you just tuning in, I know a lot of people are starting to hop on, right? Money Mondays, we do it live every Monday, 3:30 p.m. We go through a lot of different topics. This week we're talking about due diligence and multifamily. Some of our experiences of what we've seen, what we've done, right? How Ben lost his hair. We'll go through all that because due diligence can be a little hectic, right? I mean, it's depending on the deal.
It definitely, he always throws me off with those hair jokes. It's going 5 weeks in a row. I'm just
got to keep it up every time, and
it's all good.
And more importantly, right at the end of this, we'll do live Q&A. So if you have questions, go ahead and ask them. It doesn't have to be about due diligence. We'll talk about pretty much anything real estate, entrepreneur related. So feel free to ask questions. And before we kick it off, right, let's keep going. All right. So let's see. So David says, hey, Iggy. David, it's a long time no see, man. I saw you, 2-3 days ago? We had a happy hour on Multifamily Masters this past Friday.
Nice.
So
I love technology.
Hang out with my friends, and David is on there too, so I got to hang out with him.
Good deal.
Nora says Money Mondays,
Thank
of course,
you, Nora.
right?
All
We're the best at that. Jeff Greenberg says hi. Hey, Jeff, how's it going?
Hey, Jeff, thanks for hopping on,
Sam says,
buddy.
what's up, Ben and Ferris? Sam,
I
owe you an email about the deal. I'm so sorry. It's been crazy, but I will get you that by tomorrow, Sam, so I've not forgotten. Sorry.
Always his fault.
That's on me. My bad. But I will get back to you, Sam. So I'm glad you messaged us. But
we're doing our due diligence, right? Is what you should have said. No, not on Sam, but on the deal.
We know Sam's a good guy.
So. No, but we're talking about. Let's just get to the crux of it. You can have a 10 to 30 day process where you're doing due diligence on everything. I really consider the on-site due diligence is usually a 2 to 3 day process, right? Here are some of the major things that you need to understand what's going to happen here. You're going to have your general contractor and your various trades come out and bid out the different work that you're going to do on the rehab side, right? From the interiors, what's your interior upgrade plan going to be and how much is that going to cost you, to things like the roof. How much is the roof going to cost? You're going to scope your plumbing lines. You're going to see how much is it going to be to update that office or add that playground, right? Yeah. That's a big part of it. And as sponsors, right, that's where you're going to probably have the biggest bang for your buck as well while being on site. right?
Yeah.
You know,
maybe so who's the team that you have out there?
yeah,
Maybe
so
let's start with that, right?
Yeah, so the team is usually the buyer group, right? You know, and then you're going to have your general contractor. Then you're going to have your property management company, right? Your third-party property management company is going to be out there, and they're going to do the unit walks. They're going to do the lease audits, right? And sometimes they'll give you a property condition, report too, just their general condition of the property, along with doing a market survey, right? And we'll get into the different components here in a minute.
Yeah, absolutely. And like Ben said, right, have all these lined up beforehand, right?
Absolutely.
Typically, one tip that we recommend, and you should absolutely do, is don't sign your final PSA with the seller. PSA is what, Dan?
Purchase and sale agreement.
Right. So don't sign that document that literally puts it all in writing, and then start to go try to queue up your due diligence. No, we sign it, next day we're on site with all the teams, right?
You got to be buttoned up.
Get ahead of that, work with all those people, your GCs, your PMs, and everything, right? Whatever you're doing. And so I think that's critical. And then, that kicks off your due diligence, right? And typically, maybe let's talk about how that day goes before we dig into the details, right? Typically, the teams are taking care of 99% of it. We're there and we follow along different aspects, right? For example, we want to better understand the tenant base. We'll go do some of the unit walks, right? We want to better understand the area. Maybe we're spending more time on the market surveys.
Yep.
We want to go understand the staff. Maybe we're spending more time in the clubhouse, right? So as sponsors, right, you need to trust your team does the right things, and you're out there verifying, validating that they're doing it right, but you're also focusing on the things that apply the most towards you, right? So I think that's
and we'll do so. We kind of divide and conquer, right? I think as a sponsor, going back to my earlier statement, right? A lot of what you're doing is you're painting the picture, right? What am I going to do with the rehab? What is going to increase the value of this property in the best possible way, right? So you're going to work with your contractors to obviously do that. That's a big part of what you're going to do during those 1 to 3 days, right? Lease audits. Let me just get you a little bit of a breakdown of what this is, right? Your property management company is going through each and every lease, making sure that the rents, coincide with what's on the rent roll, that there's a lead-based paint addendum, that there's secure deposits. All this matches with the information that you use to underwrite the deal, right?
Did they screen the tenants or not, right?
Did they, was there overrides of, say, criminal and credit? If you find out that 100% of your tenants were overridden, and you find out that most of them couldn't have actually gotten to the property in the first place, that could be a big problem. Because what are you going to try to do? You're going to try to come in, you're going to try to increase the value and do some work and increase the rents. They're not going to be able to pay that, right? So you're going to have a lot of turnover. So that's one of the reasons why you do a lease audit, but you're not going to be doing that. Your property management company is going to be doing that, right? Then the other part of this is the unit walks, right? You're going unit by unit, and you have to see 100%. Sometimes that's why you have to come back a second or a third day, because you might have to drill locks, or you might have to, re-inform, tenants that, hey, I'm going into your unit to let them know, right? And you're going, unit by unit and looking and making sure that all the major mechanical systems that are within the unit itself look good, right? It could be good, bad, or ugly, right? The flooring is good shape. The dishwasher is bad, right? The refrigerator is new. They will give you a whole assessment of this in a report that pretty much breaks down the condition of each and every unit. And that's another thing that's going to tell you what might be happening. If you see a lot of plumbing, like where there's water, leaking from the ceiling, or there's a lot of patched holes, maybe you've got a lot of plumbing issues, right? So that's another reason why you do that. And also ultimately to kind of get a feel for what the tenant base is really going to be too, right? If you walk into every single unit and there's 3 or 4 mattresses on the living room floor, you know what kind of tenants you have, right? And that's actually a good point too, though, right? There's 3 people on the lease, but there's clearly 10 people living there. All right, well, that's a problem. Yeah,
right?
it's a big problem, right? Especially if you're doing an all bills paid property, or you're having to rub back, some utilities, right? That's going to skew up. That's going to skew your metrics a little bit.
Yeah. So let's pause really quickly. So for those tuning in, Mondays, do it every Monday, 3:30. Typically, we go for about 30 minutes, right, up until 4 o'clock Central. Going through a bunch of different topics. This week we're talking about due diligence, right? And at the end of this, we'll go through a live Q&A. So if you have questions, go ahead and drop them. We'll go ahead and talk through them and answer any questions you guys want to know. And on that point, Elaine says hi. Hello, Elaine. And Jeff says, more importantly, Ben, you need to give Ferris some grief on that scraggy beard. All right, I'll fix the scraggy beard. I'll trim some of this and give it to Ben.
I did shave today. He looks like
he's talking about my scraggy beard.
I know. But I tried to trim mine up a little bit.
All right, I'll make sure. I got to bring a beard set here to the office.
Jeff's just coming to my rescue.
Yeah. It's all good. So.
All right, so important steps. So I'm jumping around a little bit, right? But as I'm trying to show folks as a buyer, as a sponsor, these are the things that you should probably be focusing on, right? Whether it be the rehab, whether it be, we usually walk, I'd say 20, 25% of the units, right? Just for us to get personally
That's
a feel
me
for
and Ben. The staff walks 100%.
Absolutely, right? And then the other thing that I like to focus on a lot whenever we're taking over properties, the market survey, I want to understand the market, right? I want to understand the comps. What are they doing that we might not be doing? If all the guys down the street are getting $300 more, what are they doing on their upgrades? Why are they getting $300 more? And ultimately, folks, it's a really dumb business. All I'm going to do is I'm going to copy what this guy's doing. Right, and I'm just going to execute.
Unless you want to be a trailblazer, and we don't like to be the trailblazer. No, we like to find more proven ways to push rents.
It sounds risky, right? So ultimately, you just say, okay, these three guys are already doing it, and they're getting $300 rent pops, and they're adding stainless steel and granite countertops, right? If I can work that into my rehab budget, I know that I can make $300 delta on my rents. Right, so that's huge. That's why you do the market survey, and then also just get an understanding of what the market looks like. Right, is there a bunch of rough retail, or maybe there's a Whole Foods down the road or something like that, right? And you just kind of get a better feel for the market, right? And you would have done a lot of this on due diligence up front, but it's always nice to drive around, right?
Absolutely. And so let's talk about kind of the documents, right?
Yep.
So up front, right, we mentioned we get all the leases, you get all of the, the vendor agreements, right? Because again, you as a buyer, right, you're going to step into all the agreements that they have because those agreements are with the properties typically, right? And so whether it's laundry and you have a 10-year lease left on the laundry and you're not going to get to pocket any of that upfront money or whatever that looks like, right? Your team is doing all that. But really, let's talk about, but what I care more about is what is the output. So us as buyers, right, typically you're getting a due diligence report. And that has the breakdown of how many, a lot of times, and again, different vendors will do it differently, but a lot of times they go into every unit and they'll rate things with kind of a good, very good, a bad, kind of 1 out of a 4 scale. And you can quickly get a feel, like we bought one property, right, where we found out, we didn't know this beforehand, but during due diligence, we realized 90% of the water heaters and ACs were replaced within the past 3 years. Guess what?
That's good information.
That's really good. We were happy to know that, right? It makes it a lot easier for that. And so you're getting a report where they basically highlight all the deficiencies. Oh, the ceiling was caving in here. We found some foundation problems here, right? And really kind of making sure that there's no big surprises, right? And as a buyer, you have to always assume that there's going to be some things that are discovered during due diligence, right? The question is always just about, is it more than you can kind of handle, right?
Yeah, and sometimes you might be pleasantly surprised. Most of the time you're not, right? It's usually going to be the worst side of it, right?
You're looking for the skeletons in the seller's closet.
Yeah, you definitely are. And in a lot of ways you'll find out that, there's more vacancy that maybe than was on the rent roll, or that the property's condition is in a lot rougher shape than you thought it was going to be. Because remember, folks, like, we're making offers throughout the Southeast and throughout Texas, right? We're not going to be able to see every single property before we get out there, right?
Speaking of offers, if you're a broker and if you have a good deal, we'd happy to take a look.
We're looking for deal flow.
We're always looking to buy deals. If you're another buyer and you need help, we're happy to kind of get involved as well. So.
Yeah, we're trying to spin that up, right? So, we're trying to kind of,
we're absolutely looking to continue to buy deals.
Yeah, we're trying to, harness our due diligence skills here. So how can we do it without having a deal? So, that's some important documents that you need to kind of, be realistic of is, once again, the report that your property management company is going to be giving you. Also, the quote that you're getting from your different contractors and your general contractor. That's going to really play a big role in what your final rehab plan is going to be, right? The market survey is a huge thing, right? And that's the market survey, like we talked about before, is you're going from property to property, you're determining what rents they're doing, what kind of concessions they're doing, in general, just information about your competition. That's huge, right? You're going to use all of this to fine tune your final underwriting, and you're going to submit that to the lender, or you might use that as some kind of a negotiating tool with the seller, right? Maybe there's some major deficiencies, and you use that as ammo. Say, hey, look, you told me that all the ACs were new, and I found out that 50% of them are on their last leg. You lied to me, right? And that 50% is going to cost me $500,000. I need some relief here, right? Yeah. So that's, we talked about what are some red flags that you would kind of see, and I would say, we talked about some of them already, right? Mattresses, multiple mattresses in the living room.
Where if the leases aren't matching what you got on the rent roll, there's a bigger problem, right?
That's huge.
If you don't even have leases for some people, what they have on the rent roll, because then that's a problem too, right? If they have to do other stuff, you have to show that you have a lease with those people.
It could actually be illegal.
Yeah, there's some problems there. Foundation problems, if it just those can get expensive,
Plumbing.
depending on what it is. Yeah, I would also say, plumbing, guys. Look at your plumbing.
Yeah.
That's kind of that's the hidden expense on all these freaking properties.
Well, and scope your lines, right? You don't have to scope 100%, right? We always do probably 40 or 50% of the property because it can start kind of becoming cost prohibitive to do, right? And ultimately, it's not going to 100%, you're not going to see every nook and cranny of the plumbing lines. But it gives you a good idea of the condition overall of what the plumbing is. Because that's something, regardless if you did a property tour or not, you're not gonna know the condition of the plumbing, and they're not gonna allow you to do that during a property tour anyway. Same thing with foundation. Unless you're just a foundation expert and you're sitting around going and looking at the foundation the whole time during the property tour, you're not gonna know that either. Now, most things like the roof and stuff, you're gonna have had a good idea, a sense of what that is. But maybe there's a part of the property that you didn't see, right? Because the broker didn't lead you down that path. Yeah. That could be a big red flag too. Think of the things that are going to blow up the deal. The things that are going to be really, really expensive, or could come back and bite you in the future, right, with the tenants.
And you bring up a good point too, right? You're looking for stuff that the lender might find, because
yes.
You're doing your due diligence those first few days. Well, the lender's going to be out there 20, 15, 30, 60 days later, depending
yep.
obviously on your timeline. But you got to make sure that the property is going to show well for the lender,
yep.
right? And if you have some issues there that you need to get the seller to address beforehand, you got to get ahead of that. Because again, the last thing you want is for the lender to get out there and not get comfortable with the deal, right? So I think that's kind of that's a side thing that you are absolutely needing to look at, right? Because you're putting it, and even that too, right? In your investor's eyes too, right? If an investor comes out there, is the property, is it an attractive property? Is it going to meet the business plan? It's not that all properties are attractive, but the returns need to match the attractiveness, need to match the business plan, right? Do all the things line up is maybe the better way.
And it's a difference between it being tired and not updated and being dilapidated and falling apart, right? Like, you have to make that determination. You and your team and your general contractor need to say, hey, can I make this work within the budget that I have, or is it just fundamentally flawed? Right, and in that case, do I either renegotiate or I walk away? Yeah. That is baseline what due diligence is all about, right?
Absolutely.
So let's go. So we had some open Q&A. Yes. We had a couple questions come in.
Some people sent in some questions beforehand. Yep. For those of you tuning in, right, Mondays, we do it every Monday, 3:30 p.m. Central. Right, and typically we're going through different topics. This week is due diligence, but again, we typically will go through any questions you guys want to ask on the Q&A side. So us, that's the most valuable part of most things, and so if you have questions, feel free to ask them. I know some people came in, so let's just kind of read through really quickly.
We want it to be interactive, everybody.
Absolutely.
That's the most important thing.
Someone's going to ask me how you lost your hair. One person. Which deal it was. And I was just talking to a broker earlier today about that deal. And our favorite lender came up in that conversation. I got to update you on that one.
We won't say anything.
Let's see. So Savian says third-party reports that are due, lender, survey, engineering report, appraisals, etc. That's actually a good point. So that is an important part of due diligence, but know as a buyer, right, it's hard to get those from the lender beforehand, right?
You're absolutely not going to get that.
Even though you have to pay for them, right? The lenders typically hold on to it. They're making sure the appraisal all matches. Typically, they're making sure that it's not going to blow up the deal for them, but it's odd that we as a buyer, you don't really get to see that until later. And
you got to ask for it too.
That's what I was going to say. After you buy a deal, absolutely, every deal we buy, we go back to the lender and ask them, hey, can we get a copy of the appraisal?
You have to ask. They're not going to give it to you.
That's a kind of in my mind, dysfunctional part of this business. I'd never understood that. But
no, but to the point, those are absolutely great documents to have, but you're not going to get that during your first 10 to 21 days, right? Yeah. It's just the lender is looking for, and ultimately they work on their own timeline, and usually you don't want to get your lender involved and order those appraisal reports and those third-party engineering reports until you know you're going to close, right? So I always tell people, like, hey, we're on site for 2 or 3 days. Me and Ferris, when we leave that property, that final day, we know if we're going to close.
Yeah, we're like 95% sure.
Yeah, there's no.
We know if we're buying it or if there's any. It's not. Yeah, it's that we know that there was no surprises that's going to block it.
There's not going to be anything that's going to be like, oh man, we gotta back out of this thing, right? And so ultimately that should be your test at the end of that process is, do I feel comfortable closing this, right? Equity aside, debt aside, just does my deal and my underwriting and my numbers still work?
Am I going to be able to perform? Period.
Yes.
All right, let's see. So Jeff says, on the sell side, have you ever heard of a buyer ask for a pro rata share of any contract, signing bonuses, laundry, cable, etc.? I have not, but as a
they're absolutely.
I mean,
people
you
do,
absolutely
right?
can and do. We've never done it. I don't think, right?
I mean, but
you should. It doesn't hurt. My advice, and Ben knows that I like to negotiate probably too much, but I'm a believer in a lot of times you lose nothing for trying, right? And and there's a fine line there, right? You don't want to piss off anybody. But in the very first round, here's the things that I'd like and just pretend like they're normal and see if you get any pushback. Then you guys can start to go back and forth. And so things like that, if there's a deal where they took a $100,000 sign-on bonus for doing a 5-year contract and you're only a year into it, I might say, hey, like I expect some of that $80,000.
Yeah, some kind of pro rata share of that, and absolutely, that was the example I was going to give, right? Is that they had done it probably a year or two prior, and it's maybe even not even a 5-year, maybe it's even a 10-year contract, right? And so you're stuck as a buyer with the other 8 or 9 years of that. You should therefore get some benefit of that. I think that's a fair point.
I agree. Do you like how I did that?
Great, man.
You like how I stole your example?
Yeah, you're good.
I stole it beforehand. I can read his mind, guys.
You're good.
All right.
So how long does it take?
Actually, let's keep going through these, and then we can go through the whole screen.
All right, gotcha.
All right. So Savion says, agree the lender is your biggest partner. Absolutely. You guys have to see that. Don't think of the lender as a competitor. No. They are absolutely your biggest partner, and they can absolutely make your life terrible if you're not.
They're giving you 80% of the money to buy the damn thing, right?
So they got to cover their, 70%. They're running a business too, so they got to make sure it's safe and secure for them. So realize that. Come to terms with that and then act on that.
Well, the one thing that I want to point out too, right? So sometimes appraisals, sometimes property condition assessments, sometimes engineering reports come back better than expected, right? Now, if those come back better than expected and making sure that the numbers jive with this as well, sometimes that's going to affect your load proceeds in a good way.
Yeah.
It might affect your spread in a good way, might affect the amount of interest only years that you get. So, ultimately it's not always a bad thing. You don't always have to feel like it's you against them or you got to hide stuff from them, because and with these good properties, sometimes that can be to your benefit too.
Absolutely.
All
right. So next question, Sam asks, how do you estimate exterior painting? How many quotes do you usually get for each trade? Right. I think that's kind of a
Sam, you asked that question before, buddy.
It's a vague question. Yeah, he wants us to answer it twice, see if we answer at the same time. Hold on, let me look at what I told you 2 weeks ago. No, but I think ultimately it depends on the deal. Some deals have a lot more brick, some deals are all siding, right? But roughly my feedback to you, Sam, is for a 200-unit property, right, it's going to cost you anywhere between $120,000 to $200,000 to paint, right? That said, if that $80,000, $50,000, $40,000, $30,000 discrepancy blows up the deal's probably too tight.
Yeah.
Right. And so typically, we have kind of a trusted vendor that will take due diligence. They'll give us their terms, and we know that they might, be high or low compared to someone else. But again, you're trying to ballpark things. Then before we go do the work, then we'll get 3 other bids. We'll kind of dot the I's, cross the T's, right? And so due diligence is not about getting the exact amount, but about getting the right ballparks and making sure there's no big surprise. Because, we always buffer and send in really 10% roughly of just random buffer that we just a bucket that we want to tap into. And on bigger deals, we might even have more buffer. So it's important to make sure you have the reserves, not even the lender required reserves, but like literally, what do we call it, our slush fund? I mean, I forget what we call it with the lender. We call contingencies. Yeah, what we actually call it.
Yeah. Because you absolutely have to, because things change, folks, right? Like you can go through and do your due diligence, right? Then you buy the property. That doesn't necessarily mean that things won't change in that 2 to 6 month process afterwards, right? You might realize, hey, I got to spend more money on the roofs than, say, plumbing, and you've got way too much money in your plumbing budget. So you might have to go back to your lender and kind of reallocate. But that's why you have to have that buffer in there, because that gives you the wiggle room to do that, right? But I wanted to mention something on paint too, right? Most of the vendors that we use two great GCs. They usually give you 3 paints to, one's going to be kind of the full exterior. One might be the balconies, paint that black, or the railing, excuse me. And then you might have another color that's an accent, right? Maybe it's the door, right? So when we talk about the numbers that we just talked about, right, you're getting 3 different colors. So something to kind of think in, because they've already thought through that,
and
right?
If you're off on the budget, go buy some paint, roll up your sleeves, and
on some of the smaller deals, you certainly can, right? But sometimes you kind of give what you pay for too. So just realize that not all paint's created equal either. Yeah. So
all right, so let's see. So next question, Savion says, if you are a sponsor who doesn't have earnest money deposit, money for due diligence is there anyway. Maybe raise money for early on, and maybe reimburse due diligence costs to investors with the acquisition fee, not counting earnest money, obviously. So a couple things. If you're looking for earnest money, right, that's where partners come in, right? If you don't have the earnest money, but it's a good deal, find partners that like the deal, right? Partners will put up that earnest money, right? Now, in terms of that is reimbursable, right? Your kind of closing costs are reimbursable. Those come in later. So again, up front, you need to have the money for the earnest money. You need to have all of the funding for kind of due diligence up front before you close, at close you get that back. And so my feedback is find partners.
And you brought up a good point here. Let's pause right there, because some of this stuff you'll be charged for, some of it you won't be, right? Now, we have good relationships. Obviously, we have our own property management company, but even when we use third party, they would always do it for us for free, right? But if you just say, hey, I'm no guarantees that I'm going to use the third party, they'll probably charge you anywhere from $20 to $50 a unit to kind of do the inspections, right? And same thing with a general contractor, right? If you need them to do more than just a kind of general exterior scope, and they have to kind of get in and start walking units, it's probably going to be around the same amount, right? And then on top of that, if you want to scope plumbing lines, right? Assume it's going to be, maybe even $1,000, $1,500 per building to do it. It's not cheap, right? So just you need to make sure that you have that money set aside, because if they ultimately don't do it to you for free in the hopes that they get the business, then you're going to have to pay them for that, right? And then ultimately, if you walk away, you're still on the hook to pay it.
Absolutely.
So wanted to mention that.
We still got a lot more questions, so let's keep hustling so we can kind of, so I know we're going to short on time. So if you guys have questions, go ahead and drop them, because we're happy to kind of go through them. So we're going to go a little bit of a lightning round, all right? Let's see. So Savian asks, I'm curious to know how you compare loan options during due diligence, since different loan requires different reserves, prepayment penalties, et cetera. That's a good question, right? During due diligence, you're still evaluating the loan options, right? You typically don't finalize that until after you're buying the deal. And so during that time, you're looking at, am I going to qualify for Fannie Freddie? Maybe you're on the fence, and so making that decision, you're looking at leverage options, you're looking at different lenders and what they've done. And so that's kind of a parallel path to due diligence, I'd say. Anything else to add to that?
No, you're absolutely right. And you don't want to lock that in until you've done your on-site due diligence, because once again, folks, that's when you know if you're going to move forward with the deal or not, right? Because there's other fees involved in locking in debt too, right? The lender is not going to do it for free. There's an application fee. It could be anywhere from $10,000 to $30,000. That includes those third-party reports
too. If you're buying a 2-pack or a 3-pack, it's 2x, 3x that. Ask us how we know.
Starts adding up. Yeah, it starts adding up. Right?
All right. So let's keep going then. Sam, I was about to ask what percent buffer. Yeah, I'd say it just depends on the deal, man. If it's a nice interior play, that's consistent. If you're doing across the board, full dilapidated rehab, buffer in 30%. I'm not even kidding, right? A lot of times it doesn't make or break the returns, but it does make life a lot easier on the operator side. So. Yep. That's maybe that feedback. I'd say anywhere from 5 to 30%, depending on how.
Contingency is what it is, right? So if there's something unknown that you just never could have foreseen, that is what that bucket of money is for. So it's important to have that, especially on heavy rehab.
And then you can always use that contingency to rent improving things if you end up not needing it, right? It's only about just or give it back to investors even, right? Let's see. So, Tien, I told Sam earlier I owe you guys an email. I will have that to you by tomorrow.
See, this guy's a slacker.
Well, no, same person, same email. So I'll do that.
Okay.
So let's see. What are some of the things that could come up during due diligence that would cause you to walk away from the deal? We went through some of those earlier, right? But it's ultimately, is the deal I'm buying not quite the deal that I'm getting? Right, or I think I'm buying not quite the deal I'm getting. Things like, was the previous owner institutional, and I expected they were taking care of it, and clearly they were poor boying, and all the stuff was falling apart once you got in there, right? Is there excessive roof damage, excessive foundation damage, right?
Plumbing.
Did someone crash into the car and into the building, and the seller's not going to give you a credit, right?
That's never happened to us before. No, ultimately, folks, it's a gut check, right? You have to you come in with a bucket of money. Say you've already underwritten the deal, and you had $1 million for your rehab. Right, if you ultimately get in there and you say, I can't execute my business plan that I pro forma'd without saying $2 million, you got to go back and say, hey, do the loan proceeds support this, and is it still a deal? And if it's not, then you've got a problem, right? It's ultimately numbers don't lie.
That's a big one, and the other one too is just the quality of the tenant base. Is it not what I'm expecting? You got in there and realized that they didn't run any background checks on anybody. They were overriding things, and everyone moved in the past. Because the other thing too we didn't really talk about, you're looking to see, and you can tell this from the rent roll.
Yep.
But how recently did everyone move in? Did everyone, was it a heads in bed situation or not?
And that happens a lot.
Yeah, and knowing that if it is or isn't, you're going to have different challenges. So kind of realizing all that is important.
Yep.
All right, let's keep going. Amir says, what's up? Amir, we got to catch up again.
Hey, buddy.
Definitely, we're going to do a deal with Amir sometime in the next 12 months. That's my
Sounds like he's got a deal going too, right?
Amir, I don't know. I got to see the update. He was kind of far enough along. So got to catch up and see how that's going.
Yeah, man.
Savian says, great question. About to ask the same. All right, he's got another question. How fast are you hiring a securities attorney on your team, before due diligence or after? Can you speak to things you suggest have a section for in the operating agreement located in the PPM?
So, all right. So first questions first, right? When do you engage the lawyer, right? You're going to need one to help you with your PSA anyway, right?
You have a contracts attorney doing that part. A lot of times, for us, it's the same person that does both.
Yep, Dugan Kelly.
For the security side, I guess the security pieces. I guess that's happening right after due diligence.
Yeah,
right?
that's when you decide. Once again, you're walking off and you're saying, I'm closing this. Then I would engage that SEC attorney to go ahead and draft the PPM, the operating agreement, all that good stuff, right? Which is obviously different than the PSA. Sometimes it's the same lawyer, but it's different documents, right? There was a second part of that question.
Something you suggest to have a section for in the operating agreement. I mean, honestly, it depends on your equity and what you're proposing to them, whether it's splits, waterfalls, voting rights, what things they can and can't do.
Yep.
That's very different for people. My advice to you is go read a lot of other people's PPMs and see what they have structured, right?
Yep.
On the PSA, there's a lot of stuff that we do look for, like including a non-rent ready credit, right?
Yep.
That we get if they, if a seller stops taking care of the property for the next 60 days, that we are getting a credit for each unit. And right before closing, we go walk every single, non-ready
and it could be a
unit
substantial amount of money.
Yeah.
we found I think we met with Mark Kitty. He had the biggest record, $400,000.
Our attorney
right?
was telling us about a case, where they got like a $400,000 credit just because of that sentence in there. So there's definitely a lot on the PSA side. But in terms of the operating agreement, that's very specific to kind of your scenario, your structure, and your deals. All right, so let's go through the 2 questions on the screen. So if anyone has any questions, ask them. Otherwise, we're going to wrap up here in a minute. We're already going over. So how long does it take to close after you perform due diligence?
Just depends, right? You're probably 45 to 60 days. 90.
You have extensions, things like that. But it happens fast. There's a lot going on in those 45 days. So definitely, unless it goes back to what I said, don't sign your PSA until you're ready to execute due diligence and rock and roll, because all these things are happening in tandem.
Yep.
Have you ever backed out of a deal after performing due diligence? From due diligence, there's never been a deal that we
always have a big enough bucket of money in our rehab budget we can absorb that thing that we didn't realize that we needed to absorb, right?
Yeah, I'm trying to think. We've had cases like where the lender has made things really difficult, but that's after closing. And so I don't think there's ever been a case where we did due diligence. Because again, you're also walking.
And that wasn't based on due diligence either, right?
Yeah, that's what I'm trying to say. You're walking the property. You're talking to your property manager. You're talking to people that know that deal in the area. Typically, you know a lot about what's going on. You're just making sure there's no real skeletons.
Yep.
And so thankfully, today we have not hit an issue where due diligence is a reason. What we found in due diligence is a reason to back out the property.
But we've heard that there's plenty of horror stories out there,
absolutely.
right? So shootings while you're doing due diligence and other stuff. It happens. It happens.
All right, let's see. Sabian says, great stuff, guys. I'm a realtor here in Houston, working property management as well. Glad you tuned in. No, thanks for hopping on, man. So hopefully everyone got value from it. We can go ahead and probably call it a wrap, unless anyone has any last second questions. Right, for those tuning in, we do Money Mondays every Monday, 3:30 Central. Right, we go through different topics. This week we're going through due diligence, talking through that. Next week we're going through
takeover checklist.
Yeah, we're doing takeover. That's right. Takeover checklist. Yeah.
So I mean, this is the stuff that we do, that we go through whenever we just bought the deal.
And we do have a due diligence checklist you can check out. DisruptEquity.com/DD checklist to go grab that.
Yep.
Right. We kind of put together just kind of a recap of all the things. So if you want the due diligence checklist, it's www.disruptequity.com/DD checklist.
Yep.
You should be able to see it on the screen right now.
And there's a lot of more stuff than we went over today on that list.
3 pages of stuff on there. So the team kind of helped put that together. Hey, chat, how's it going? I'm about to say bye too. You hopped on a little late, chat. Come on, we thought you were one of our biggest supporters. But we are doing well, chat. So hopefully you're doing the same.
All right.
Let's call it a wrap then.
Cool. Well, thanks everybody.
Yeah, all right. Thank you guys.